Right now, without you doing a single thing wrong, without you losing your job, without any recession being officially declared, your mortgage payment could go up by $250 a month. Your retirement account could drop 15%, and the dollar in your pocket could lose a chunk of its purchasing power, not because of anything happening in Washington, because of what is happening in Tokyo. Japan just triggered something that most Americans have no idea is coming, and by the time it shows up in your bank statement, it will already be too late to prepare. Japan's 30-year government bond yield just climbed to its highest point in more than 2 decades. The 10-year yield hit a level this country has not seen since 1998. I know that sounds like a story that belongs in a financial trade publication that nobody reads. Bond yields in Japan. Who cares, right? Here is who cares. You do. You should. Because Japan currently holds more than $1.2 trillion worth of US government debt. That is more than any other foreign nation on Earth. $1.2 trillion. And when a creditor that size starts changing how it manages its own financial system, the effects do not stay in Tokyo. They travel, they show up in your mortgage rate, your retirement account, and the price of everything you buy. So, today we are going to break this down completely on the Miller Report. We are going to explain how Japan became the most indebted developed country in the modern world, what the mechanism is that has been quietly channeling Japanese money into American markets for decades, and why that mechanism is beginning to break down right now in 2026. By the end of this video, you will understand exactly why this matters to you personally, and what the 3 most likely outcomes are for the American economy. Let's get into it. Let's start with the number that makes every economist who looks at it do a double take. Japan's debt to GDP ratio sits somewhere between 220 and 260%. That range exists because different data sources measure it slightly differently, but no matter which end of that range you use, that is the highest debt to GDP ratio of any developed nation on the planet. It is not even close. Now, to understand what debt to GDP actually means in practical terms, think about your own finances. If you earn $100,000 a year and you owe $90,000 in total debt, your debt-to-income ratio is 90%. Economists get nervous when a country hits that level because once your total debt exceeds roughly 90% of your annual economic output, growing your way out of that debt becomes genuinely difficult. The United States right now sits at approximately 125%. Using the same personal finance analogy, if you earn $100,000 a year, you owe $165,000. You already owe more than you earn. That is where America is, and most serious economists will tell you that warrants real attention. Japan is in a completely different category. At 220 to 260% debt to GDP, if you earn $100,000 a year, you owe somewhere between $220,000 and $260,000. You owe more than twice what you produce in an entire year. At any normal interest rate, the cost of servicing that debt would consume your entire income before you spent a single dollar on anything else. The only reason Japan has been able to sustain this for as long as it has is the most remarkable financial experiment of the last 3 decades. For most of that period, Japan's interest rates were at or near zero. Sometimes they were actually negative. And when you owe $8.6 trillion at a near zero interest rate, the annual cost of carrying that debt is survivable. Barely. But that era of near zero rates is ending, and that is the entire story we need to understand today. To understand how Japan ended up with a debt load this extreme, you have to go back to the late 1980s and early 1990s, because Japan was in the grip of one of the most spectacular economic bubbles ever recorded in any major economy. This was not a modest overvaluation that got slightly out of hand. This was a full detachment from economic reality, powered by years of loose credit, reckless lending, and a national fixation on rising asset prices. Japanese stocks roughly doubled during the peak of the bubble. Urban real estate values nearly tripled in some markets. Companies were borrowing against rising property values to buy more property, which drove prices higher still, which allowed more borrowing in a feedback loop that seemed to the people living inside it like it would never end. The most striking illustration of how distorted things had become is the Imperial Palace in central Tokyo. At the absolute peak of the bubble, the land beneath the Imperial Palace grounds was valued higher than the total worth of every piece of real estate in the entire state of California. Every home, every office building, every warehouse, every commercial property in California, combined, was worth less than a single parcel in Tokyo. That is how far prices had detached from any rational basis. When the bubble collapsed in the early 1990s, the reversal was severe. Stock prices began falling and kept falling. Real estate followed. Banks that had extended enormous loans against inflated collateral found themselves holding assets worth a fraction of what they had lent. Businesses that had borrowed heavily to expand could not service their obligations. Confidence in the economy collapsed almost overnight. But what followed was not a typical recession followed by a recovery. Japan instead entered something far more damaging and far harder to escape. A prolonged deflationary spiral that would last more than 15 years and reshape the entire structure of how Japanese economic policy was conducted. Understanding that deflation trap is essential to understanding everything that came after. Deflation sounds almost benign at first. Prices falling, things getting cheaper. Most Americans would say that sounds fine. But deflation is actually one of the most destructive forces a modern economy can face. And the reason comes down to basic human psychology. When prices are going up, you still buy things. You have to. But when prices are falling, and more importantly, when everyone expects prices to keep falling, the rational response is to wait. Hold your money. Buy it later when it costs less. At the individual level, that is perfectly logical behavior. At the level of an entire economy doing it simultaneously, it is catastrophic. Businesses cannot sell inventory. Revenue falls. Workers get laid off. Unemployed workers buy even less. Prices fall further. The spiral accelerates. And it is genuinely very hard to stop once it builds momentum. That is exactly what Japan experienced for roughly 15 years after the bubble burst. Consumer spending was weak. Business investment was flat. GDP growth stalled. The Japanese press called it the lost decade. Then it extended to 2 decades. The deflationary psychology had embedded itself so deeply in Japanese society that even aggressive government spending programs struggled to break it. And government spending is exactly what happened. Year after year, Japanese governments borrowed money and spent it on infrastructure, stimulus programs, and transfer payments, trying to inject enough demand into the economy to break the deflationary grip. That cumulative borrowing over decades is the primary reason Japan's debt-to-GDP ratio reached the extraordinary levels we see today. At the same time, the Bank of Japan, Japan's central bank, kept interest rates at or near zero to make borrowing as cheap as possible. They launched massive quantitative easing programs, purchasing government bonds in enormous quantities. They introduced yield curve control, committing to buy whatever bonds were necessary to keep yields from rising above a set ceiling. The result is extraordinary by any standard. The Bank of Japan now owns approximately 50% of all outstanding Japanese government bonds. For the 10-year bond specifically, the central bank owns roughly 90% of the entire market. The Bank of Japan is not a participant in the Japanese bond market. It has essentially become the market itself. For the first time in a generation, inflation has arrived in Japan. Not at the levels that hammered the United States and Europe over the past few years, but by Japanese standards, prices are rising in ways that feel genuinely new and unsettling to a population that spent 30 years in a flat-to-falling price environment. In everyday terms, you see it at supermarkets and restaurant chains, at the places ordinary Japanese people spend money every day. A standard bento box lunch that used to cost around 480 yen is now running 530 to 550 yen. Eggs, cooking oil, basic grocery staples have all climbed. These are not massive numbers in isolation, but in a society that spent 30 years expecting prices to stay flat or fall, a 10% jump on everyday items is a genuine cultural disruption. 10% might not sound dramatic to an American who has been living with elevated inflation for several years. But for Japan, a society that built its entire financial and psychological architecture around the assumption of flat or falling prices, a 10% rise in everyday goods is a genuine shock. The cultural and behavioral adjustment is significant on its own, but the policy implications are even more serious. Because for the Bank of Japan, inflation arriving creates a trap with no clean exit. The entire structure of Japan's debt management, Zero interest rates, massive bond purchases, yield curve control was built specifically for a world where inflation was not a problem. Now that it is a problem, the central bank has to choose between two bad options. Option 1, raise rates to fight inflation. This controls prices but massively increases the cost of servicing $8.6 trillion in government debt. Japan's debt servicing bill is already $230 billion a year, which is 25% of the entire government budget. Any significant rate increase sends that number to levels the government simply cannot sustain. Option 2, leave rates low and accept the inflation. But artificially low rates in an inflationary environment erode confidence in the yen. Investors move capital out of yen assets. The currency weakens. And a collapsing yen triggers a currency crisis that compounds every other problem Japan is already facing. The current Bank of Japan rate of approximately 3% reflects the uncomfortable reality that they have to raise rates. But they know every step higher makes the debt situation more precarious. It is a trap, and the walls are closing in from both directions. Now, we get to the part of this story that connects directly to your financial life here in the United States, and it requires a concept that gets thrown around in financial media but rarely gets explained clearly. The yen carry trade. Let's build it from the ground up. For roughly 3 decades, the Bank of Japan kept interest rates at zero, sometimes below zero. If you are a large institution, a pension fund, an insurance company, a major bank, and you can borrow enormous amounts of money at effectively no cost, that is an opportunity. And institutions around the world, not just in Japan, spotted this opportunity and exploited it systematically. Here is how it works in simple terms. You borrow $1 billion worth of yen from a Japanese bank at a near zero interest rate. You convert that yen into US dollars. You invest those dollars in something that pays a real return. US Treasury bonds at 4 or 5%, US stocks, US real estate. You collect that return. At the end of the year, you repay your yen loan, which costs almost nothing, and you pocket the spread. A concrete example makes this vivid. Say a Japanese pension fund borrows $1 billion worth of yen at 0.1% and uses it to buy US Treasuries yielding 4.5%. The spread between what they pay and what they earn is 4.4% points. On $1 billion, that is $44 million per year in essentially risk-free profit. Multiply that across dozens of large institutions over many years, and you are talking about hundreds of billions of dollars flowing into U.S. markets, U.S. bonds, and U.S. stocks every single year. That enormous sustained flow of Japanese capital into U.S. assets has been one of the structural supports of American financial markets for decades. It kept demand for U.S. Treasuries high, which kept U.S. interest rates lower than they otherwise would have been. Lower rates meant cheaper mortgages for American homebuyers, cheaper borrowing for American companies, and a more favorable environment for equity valuations. Now, the math has changed. The 10-year Japanese bond yield is currently around 2.1 to 2.2%. The 30-year hit 3.3% and briefly approached 4% last month. You can no longer borrow at 0.1%. Once you factor in currency hedging costs and transaction fees, the spread between borrowing in Japan and investing in the U.S. has shrunk dramatically. The free money is gone. When the math of the carry trade stops working, rational institutional investors do exactly what you would expect. They close the trade, they unwind the position, and that process of unwinding, happening simultaneously across many large institutions, is precisely what is beginning to unfold in global markets right now. Here is the mechanics of it. A Japanese life insurance company that has spent years holding U.S. Treasury bonds as part of its carry trade strategy looks at the current numbers and concludes the trade no longer makes economic sense. The spread is too thin. The currency risk is not worth it when Japanese bonds now offer competitive yields with no foreign exchange exposure. So, the insurance company sells the U.S. Treasuries, takes the dollars, converts them back to yen, pays off the yen loan at the Bank of Japan. Done. Now, picture that sequence happening across dozens of institutions with positions worth hundreds of billions of dollars, all of them selling U.S. Treasuries, all of them converting dollars back to yen, all arriving at the same conclusion through the same logic at roughly the same time. The aggregate effect of all that selling is a massive amount of downward pressure on US Treasury bond prices. When Treasury prices fall, yields rise. That is just arithmetic. And when US Treasury yields rise, the effects cascade through the entire American economy in ways that are direct and personal. Mortgage rates rise, benchmarked against Treasury yields. A 1% increase in the mortgage rate on a $400,000 home adds approximately $250 per month to your payment. Over a 30-year loan, that single percentage point costs more than $90,000 in additional interest. Not the loan amount, just the extra cost of borrowing. For a family trying to buy a first home, that difference is often the difference between qualifying and not qualifying. Stock valuations come under pressure. Higher rates change how investors calculate what a company is worth in present value terms. A company doing exactly the same business, generating exactly the same profits, can see its stock price fall when the rate environment shifts, because the mathematical framework for valuing future earnings changes with rates. And the U.S. federal government's own borrowing costs rise, crowding out spending on everything else. We got a small preview of this in April of 2026 when Japanese investors sold more than $20 billion in foreign bonds in just a matter of weeks. Markets wobbled. That was the early warning. A full-scale unwind would be a much larger version of that same event. Everything we have covered so far would already be a serious situation on its own, but Japan is also dealing with two structural forces that compound every problem we have discussed. And they deserve serious attention because they affect the long-term trajectory of this story. The first is demographic collapse. Japan's population is not just aging, it is shrinking at an accelerating rate. The working-age population, those between 15 and 64 years old, now represents about 59% of Japan's total population. That is well below the global average. Japan's total population, which reached approximately 128 million in 2010, has already fallen below 122 million today. Projections place Japan's population at roughly 75 million people by the year 2100. Last year, Japan recorded fewer than 687,000 births. That is the lowest birth count since the government began tracking the statistic in 1899. This is not a temporary trend that will reverse. It is a structural collapse in the demographic foundation of the economy. Why does this matter for the debt crisis? Fewer workers means less tax revenue. Less tax revenue means a wider gap between what the government collects and what it owes. And with fewer workers, GDP growth slows, so the denominator in the debt to GDP ratio is not growing fast enough to offset the debt. Even if Japan does not add a single new dollar of borrowing, the debt to GDP ratio gets worse every year simply because the economy is shrinking. At the same time, an aging population generates massive welfare and healthcare costs, putting more pressure on a budget that is already stretched beyond its limits. The second compounding factor is that Japan is not alone in dealing with a serious debt problem. The United States is at 125% debt to GDP. The United Kingdom, France, and Italy are all running large deficits. Most major economies in the developed world are competing for the same finite pool of bond buyers right now. Pension funds, insurance companies, sovereign wealth funds, and foreign central banks have a limited total capacity to absorb government bonds across all markets simultaneously. When every major government needs to attract bond buyers at the same time, the competition for that capital drives up the yields that governments have to offer. And higher yields mean higher costs for every borrower in the system. If Japanese institutional investors step back from buying US Treasuries and concentrate their capital in Japanese markets instead, the US government has to find replacement buyers. The only way to attract them is to pay more, and paying more means higher rates for everyone. Let's talk about where this goes from here. There are three plausible scenarios, and understanding each one helps you prepare for what may be coming. Scenario 1 is the soft landing, the slow grind. This is the most probable outcome, and the reason for that is specific. Japan has been managing this debt situation for 30 years without triggering a catastrophic global event. The Bank of Japan has a consistent history of moving slowly, communicating its intentions carefully, and avoiding sudden policy shifts that would send shockwaves through global markets. In this scenario, Japanese bond yields rise gradually. The Bank of Japan reduces its bond purchases over an extended timeline rather than abruptly. Japanese institutions slowly rebalance away from foreign assets and into domestic bonds, but at a pace global markets can absorb. US Treasury yields drift somewhat higher over time. Mortgage rates increase. Stock valuations face some headwind. American borrowing costs rise at the margin. Americans feel this as a slow, persistent squeeze rather than a sudden shock. Housing gets more expensive, gradually. Portfolio returns are somewhat reduced over time. The purchasing power of the dollar erodes incrementally rather than all at once. This is uncomfortable, but it is manageable. Scenario 2 is the rapid unwind. This is where the situation becomes dangerous. If Japanese bond yields spike faster than expected, moving to 4 or 4.5 or 5% on the 30-year bond, the economics of holding U.S. assets flip sharply negative for Japanese institutions. They would face powerful incentives to close their foreign positions quickly. Forced selling at scale is disorderly selling. When institutions sell urgently, they accept whatever price the market will bear. That pushes Treasury prices down sharply, spikes yields, triggers more selling from other investors who see the move and panic, and creates the chain reaction we have been describing. We saw the beginning of this in April of 2026. A full-scale version would be a significantly larger version of that event. What could trigger Scenario 2? A major geopolitical shock. A sudden move in the yen that forces rapid position adjustments. A faster deterioration in Japan's fiscal position than markets expect. Scenario 3 is a full fiscal crisis. This is the least likely near-term outcome, but it cannot be dismissed entirely. In this scenario, Japan's debt becomes genuinely unmanageable. The Bank of Japan is forced into emergency money printing to keep the government solvent, and hyperinflationary conditions emerge in Japan alongside a full currency collapse. The global financial system has never processed an event of that magnitude from a country of Japan's size, and the consequences would be severe and wide-reaching. Here is what all of this means in practical terms for you. Regardless of which of those 3 scenarios plays out, the direction is the same. Americans face higher borrowing costs, a more expensive housing market, and a dollar that purchases less over time. The only variable is how quickly those changes arrive and how disorderly the transition turns out to be. For 30 years, the United States has quietly benefited from cheap Japanese capital flowing into American bond markets. That steady flow of money kept U.S. interest rates lower than they otherwise would have been. It allowed Americans to borrow more, buy bigger homes, fund retirement accounts, and run larger government deficits at manageable interest costs. The structural foundation of that arrangement is now fracturing. The era of cheap borrowing underwritten by foreign capital is ending. It is not ending because of a single policy decision or political event. It is ending because the underlying conditions that made it possible are changing. Japan's rates cannot stay near zero when inflation is rising. Japanese institutional investors cannot ignore the returns now available in their own markets when Japanese bond yields are genuinely competitive with foreign alternatives. What should you do with this information? If you are thinking about buying a home, understand that the rate environment is likely to remain elevated or drift higher. The period of historically low mortgage rates is not returning in the near future. Plan your budget accordingly and avoid overextending based on hopes of rate cuts. If you hold U.S. equities, understand that higher rates create a headwind for stock valuations. That does not mean markets cannot rise, but the tailwind that low rates provided to equity prices for many years is no longer operating in the same way. If you care about the long-term purchasing power of the dollar, watch Japanese bond yields. When those numbers move, the effects reach across the Pacific. Diversification across asset classes makes more sense today than it did 5 years ago. We will keep watching this story and bringing you updates as it develops. This is not a crisis that arrives and ends in a week. It is a structural shift playing out over months and years, and it will continue showing up in your financial life whether you track it or not. That is the Miller Report for today. Stay informed, stay prepared. We will see you in the next one.